Tesla institutional analyst Andres Sheppard of Cantor Fitzgerald just dropped a note after visiting Tesla's factory in Fremont and having an in-depth conversation with Tesla Investor Relations. They expect Tesla's Robotaxi event on October 10th to be a significant catalyst for the stock. They explain in detail their thoughts on full self-driving over the long term, the rollout of FSD in China, Tesla's plan to introduce low-cost vehicles, and the forecast for total deliveries for 2024. In the meantime, a big shocker, Stellantis, as they announced their current CEO, Carlos Tavares, will now be replaced. This was somewhat predictable, as Stellantis has been the fastest market share loser amongst all large automakers. So I've got Hans Nelson joining us. Hans has his own YouTube channel called Hans C. Nelson. Thank you so much for taking the time to join me, Hans. Appreciate this.
Yeah, thanks for having me, Herbert.
So we've been watching institutional analysts, these big whale investors. They've been, skeptical of Tesla for so long. Now, one by one, almost, the majority of them are now talking about Tesla as a, auto company with new vehicles coming out. They're getting excited. We're seeing them talk about Tesla as an energy company. And in fact, they're seeing Tesla as an FSD, Robotaxi eventually, and bot company. So this particular note, you can see that, Cantor Fitzgerald, for one, does believe and see these things coming forward, although surprisingly, their price target for this year is still neutral. We'll see that a little bit closer here. So this is Andres Sheppard. He is giving a neutral. Still, the price target is 245 for 24 months. But again, if you take a look at what he says here, it's all incredibly positive. So last week, we toured Tesla's manufacturing facility in Fremont. During the visit, we had the opportunity to tour the company's production lines, test drive Tesla's newest FSD software, and have an in-depth conversation with investor relations ahead of the Robotaxi unveil on 10/10. And this is their key takeaways. The first one is we expect Robotaxi unveil to be a big catalyst. Tesla's planning to unveil its Robotaxi this October 10th. We expect this to be a significant catalyst. And the auto and ride-sharing industry. We expect Tesla to roll out Robotaxi in phases in select markets, and they expand over time. We also expect this will add pressure to alternative ride-sharing companies such as Uber and Lyft. Recall that on September 13th, Uber extended its partnership with Waymo to offer driverless ride-hailing trips to customers in Austin and Atlanta. So they're being very bullish that this is going to be a good, significant catalyst. What's your thinking?
It's interesting to see how they're reading this, that they are saying, yes, they're acknowledging that this is something that has the potential to be transformative, but then they're also talking about it in the context of, just putting pressure on other autonomous services. And this seems to be a view that we do hear a lot more from mainstream institutional analysts these days, that they're expecting Tesla's Robotaxi service to just be another one of a set of autonomous ride-hailing services, and they don't expect the unit economics of Tesla's Robotaxis to really have a super competitive advantage that drives outsized market share by Tesla. And so I think that's how you can have an analyst who is bullish on FSD potentially being able to participate in Robotaxi service revenue, but without necessarily thinking that that has major implications for the value of the Tesla stock price today.
Yeah, let's explore that a little bit further later. That's you can't be bullish about FSD and bots, and then even if your 10-year outlook and not have that impact your price today. We'll talk about that later. So they are bullish about FSD. This is their points here of FSD over the long term. So Tesla previously lowered its FSD subscription price to $8,000, lowered its monthly subscription $99 per month, which we continue to view as encouraging. We expect the most recent 12.5 FSD software to be well received by customers and to help boost margins over the long term. Tesla also has the potential to license the tech to other OEMs in the future, which could add another revenue stream. So nothing really, they're just repeating what actually happened, but they're kind of saying that we think that this is a good thing. Tesla to roll out FSD in China in the first quarter. On September 5th, Tesla announced its plans to launch its FSD in China. Recall that in second quarter, management stated it expects Tesla to receive regulatory approval to launch FSD in Europe and China, reaffirmed its timeline. So nothing, they didn't really say anything, but they're just saying that, yeah, we think this is all good news.
Yeah, I mean, I think a lot of retail investors really enjoy feeling like they're thesis can be validated by someone who has the credentials of, working in the industry. Um, it doesn't mean a lot to me personally that people are recognizing that at this point in time, especially since, they're not really tying that to the value of the company yet. But on the flip side, it is, somewhat understandable for them to have, because they are operating on shorter time horizons than we as retail investors can. Not all retail investors do. Um, and that introduces the question of, I have high confidence in what Tesla is able to achieve over 5 to 10 years. It's much harder to say, what do I think is absolutely going to happen in the next 12 to 24 months? And that 12 to 24 month window, even though they're saying, we're looking at what's potential, over the long term, they want to know, when do I put that buy? Because they want that appreciation to happen within the time window that they're expecting. And I think there are some large error bars on, when do we see Tesla really reach scale on a robotaxi service. And so, for someone who's got the responsibility to make investment recommendations for other people, you do have to play things a little bit more conservatively. And the question marks around the timeline of exactly when these things happen do force you to put more discounts on what you think the value of Tesla's success is going to be in the near term.
Okay, all good points. All very good points when it relates to FSD and the bot. Does not make sense when you're talking about the low cost vehicles, because he still gives the same price point of the stock today, neutral, for for the next 12 months. And of course, the low cost vehicles. So in his note, he himself says there's plans to introduce low cost vehicles. Tesla recently have reaffirmed its plan to introduce low cost vehicles, and the more affordable models remain on track for start of production in first half of 2025. We expect pricing of these vehicles to be about $25,000, which we believe will add pressure to competitors, particularly those with negative gross margins. Just that alone, shouldn't you already start increasing your price targets? Unless, right? It's like it's all just management saying this, not until they actually announce it. What's your thoughts about not increasing your price target for 12 months if you know that this is happening, or they've announced this several times already?
Yeah, it's hard to know exactly what they're thinking in this scenario. One other potential factor that you didn't mention there is that maybe they feel like that growth is already kind of priced in around that $250 price point. I don't know if that's fair or not. So that could be another factor. But otherwise, yeah, I mean, I think that personally, if they can deliver at that price point, then that implies two things. A, that they can solve the vehicle scale. Like, you can't deliver the car at that price point without being able to deliver it at scale. And if you can deliver it at scale, then you're talking about, very large numbers in revenue. So as long as the gross margins on the sales of those vehicles are right side up, you would think there would be pretty significant financial impact of actually delivering that vehicle. And the market right now, like, we know that the demand is there to purchase these vehicles because, so many new car buyers right now are just facing sticker shock at how expensive new vehicles have gotten, and the lack of available options at, prices that they find reasonable. And so if you don't want to do a lease, that, you can get into leases right now for a Tesla that are relatively affordable. But if you're looking to purchase and you would like to be able to purchase and have insurance and all those things somewhere in the $350 to $500 a month range, on something that's new, that's, pretty much impossible at this point in time. And that is the thing that a new $25,000 car offers to the market. And I think that thing will sell like hotcakes. So it'll just be about their ability to deliver in volume. And yeah, I like Tesla has shown the ability over and over again to ramp to full volume production on vehicles. And we've already seen, great progress this year on the Cybertruck. So yeah, it doesn't make a whole lot of sense to me not for that to say that you think that that's going to happen in the first half and not really to um, allow that to affect your valuation by much.
Exactly. You're supposed to be forward looking, right? You're supposed to be the analyst. You went and talked to these factories. You know what their plans are. You've understand that, and the new, more affordable vehicles are coming, and you should, it's going to be there. The start of production by first half of 2025. You need to start considering that as well.
But we also know the playbook of analysts that they wait to upgrade it to buy until after it's starting to move in a positive direction.
Right.
And so,
exactly.
Yeah.
That's right. So, okay, this is their suggestions of what they are forecast for vehicles produced and delivered. They actually think in 2024, they're expecting 1.78 million. So that's lower than the what they actually produced last year at 1.8 million last year, just slightly lower. They just kind of repeat what happened in the last weeks or the last quarters. Recall that management recently reaffirmed they expects the vehicle delivery growth rate for 2024 to be notably lower than the growth rate 2023. Having said all this, they also said that 2025 is going to be a 50% growth. So 2024, we're already in September 2024, and that's what I'm saying. If they are planning this out to be 12 months, by September 2025, when management of Tesla said that it's going to be 50% growth over 2023 numbers. But anyways, what's your thoughts about what are you expecting for 2024 in terms of total deliveries?
I would be a little bit disappointed to see lower deliveries this year than we saw last year. I wasn't expecting large growth. I'm hoping for somewhere in between 1.8 and 2 still at this point in time. We'll definitely have to keep track on the numbers. But I definitely am very encouraged by the progress of Cybertruck ramp, and we could see further progress on that. Shanghai seems to be knocking it out of the park right now. And so, those things are positive. And we'll just have to see how the rest of the year pans out. But that, to comment on, it could be that one of their concerns is that if we do really see contraction in vehicle production from 2023 to 2024, they might feel like that's going to have an outsized negative impact on the stock, even though there is growth very close on the horizon. So I don't know if that's playing also into their neutral rating, but it is interesting just to see all of the different points that they bring up.
If that's the case, they should have talked about it. They visited the factory. They had an in-depth conversation on investor relations. They should have talked about what is the near term, like the next 6 months. What's it going to look like the next 3 months? So we've seen that China is at par now with what happened in 2023, but we're in the second 2 quarters. It's going to look like it's going to skyrocket up. And then you've got Europe, though. Europe is faltering behind. They're struggling as an economy. They've removed the incentives, and now we're seeing sales there weaken. So maybe there is this kind of like, I think we're still going to hit the over 1.8 million. We're still going to be better than last year, but yeah, not much more. But that's okay. That's been already communicated. So that should have been built in. Everybody knew this already.
Yeah, and I think one of the things that the analyst is not actually discussing here that I feel like is also a major factor is the switch in the macro environment, moving to lower interest rates, the effect that has on demand and loan rates and all of those things. So it seems like now is a better time to be optimistic about that 12 to 24 month time horizon than neutral.
Okay. And then they do talk about energy generation, storage business reports record profits, right? So Tesla reported $3 billion revenue in second half of 2024 versus $1 billion last year, driven by deployment 9.4 gigawatt hours. This was driven by deployment of both Megapacks and Powerwalls, record revenues and gross profits in the segment. Supercharger station grew to 6,473 as of the second quarter. Along with supercharger connectors of 59,000 versus 57. So things are growing just as fast as they have ever been. Management expects a revenue growth rate in the company's energy storage business segment to exceed that of the automotive business segment. They get that as well. Now, it might be lumpy. So in the next 12 months, hard to say what's going to happen to energy, but I think 12 months is enough for you to say that energy is going to grow and is going to impact significantly. You know quite a bit about Tesla's energy, and what's your thoughts on this?
I definitely have high hopes for, Tesla's energy business over the long term, and it's good to see them including it in here. I think, it might still be a little while before it's a big needle mover in the stock. My gut feel is that we'll probably start seeing really meaningful positive contribution of profits from Megapex, somewhere in the general vicinity of the same time that we start seeing something from increased software sales. And, those two things together are going to be really powerful in the EPS that Tesla's able to generate, which, should then translate to multiples and just outlook and overall performance of the stock price.
Okay, so their final thoughts. We continue to believe Tesla benefits from future upside from FSD software, plus upcoming Robotaxi segment, the introduction of lower price models, a global manufacturing footprint with economies of scale, industry's large charging infrastructure. We also believe Tesla will benefit from an acceleration of AI software. Okay, again, they see Tesla as an AI company, and fleet-based profits over the medium term to long term. Separately, we're encouraged by Elon Musk's comments on the second quarter 24, in which he disclosed that there are few OEMs interested in licensing FSD, although the company did not disclose additional details. Lastly, on July of last year, Tesla disclosed that it expects to begin limited production of its Optimus robot by the end of this year. What? Oh no, July 23rd, yeah. And expects to ramp up production and delivery to outside customers in 2026. So, we believe in robots. We believe in FSD. We believe all these things that are doing. There might even be partnership. We still remain neutral in the near term given valuation. Our neutral rating 12-month price target at 245 are unchanged. We arrive at our valuation via 10-year bottom-up discounted cash flow approach of 11% discount rate, terminal value of long-term growth rate of just 2%. There you go. So despite all that, they only give it 2%. Key risks include competition for Chinese OEMs, Chinese legislation, slowdown in EV demand, and less than expected adoption of FSD and slower ramp of Robotaxi. There you go. That's their summary.
Yep. And I think that's the key there. They're going to talk about all these things that are exciting, but when you put a long-term growth rate of 2% on all of the things that you just mentioned, that just, those two things don't really go together. And I think that's where you see the disconnect between the neutral rating. They're just saying, these are all the things we're excited about, but we're not really convicted enough about any of these things to, make a stand.
Okay. Let's move on. So Stellantis, in the meantime, every single episode, it's just been one negative thing going on with the legacy automakers after another. And I don't know if people don't see the signs. Yesterday, I did a show with Jeff Lutz, and we covered that the auto dealers in China and the auto dealers here in the US, they are screaming, basically saying, "We no more, stop sending us vehicles. We can't. We've lost so much money by giving them incentives to get it off our lots." And they told the automakers, "Don't do that." Here we've got the latest news: Stellantis. They are not going to renew their CEO, Carlos Tavares. They're not going to continue him. They're dissatisfied with the situation in North America. Sales have been slowing. So this is the most recent article. This is Carlos Tavares, and it's going to go through a regular succession planning right now. Pressure on Tavares is rising to Stellantis' poor performance in markets, including the U.S. There's no plans yet for an immediate leadership change. They just won't renew him. So he's been cost-cutting, weakening, but contends with the weakening demands for electric cars. Of course, their cars. They are, as we'll show, the sixth largest electric car maker. So they're so far behind compared to what other large automakers are able to do. So they're the least capable here. The Jeep and Chrysler maker is struggling with high levels of inventories, quality issues, and declining market share. The stock has fallen more than a third. Fixing the U.S. issues will be top priority for Stellantis until the end of this year, said the CFO. Is working hard to find solutions that satisfy all the others. Yeah. What's your thoughts on that?
I don't have a rosy outlook for their ability to fix those issues here in North America in the next 12 months. So I certainly don't envy the position that these companies are in. It's very structurally difficult. And, you know, the even though Stellantis is a very large auto company because they're an international company, they're, the part of the business that they're talking about here is really Dodge, primarily Dodge, Jeep, and Chrysler. And those brands are really not super competitive with Ford and GM here in the United States. They're kind of like that distant third place. And so the pressure is really ramping up on them. Even they just don't have the strength of volume that Ford and GM have. And when you don't have the volume, then you're really looking at an even thinner razor's edge of margins that you have to deal with. And so, you know, we're seeing the consequences of reverse economies of scale as things start to shrink. It gets bad really fast, and it doesn't have to get that much worse than it is right now for it to end up being catastrophic for the company. And then if the larger international auto group is not able to absorb the losses of the U.S. segment of the business, then it becomes existential for Stellantis as a whole, not just Jeep, Dodge, Chrysler. So it's it's a tough position. I don't envy Carlos and the job that he has to do. We also know that Stellantis is one of the major buyers of ZEV credits because they've kind of drugged their feet on EV transitions. If they had not drugged their feet, would they be in a different position than they are today? I don't know. I kind of doubt it. I know that those ZEV credits are certainly, like, the amount that they're having to pay in those is not helping the situation. But just overall, I don't see them as a competitive enough player to really have avoided this situation either way. The auto business is cyclical, it's brutal, and it's oftentimes very difficult for a player in the market position that they're in to hold on through a contraction like we're seeing right now.
And then AJ said this, good follow on X at ALOJOH, said Tavares is out at Stellantis, the number 3 largest automaker globally. Stellantis CEO won't get a contract extension. They've begun search for candidates to succeed CEO Carlos Tavares, whose contract is set to expire in 2026. So like you say, it's still going to be him for a couple more years here. This was highly predictable. Stellantis has been the fastest market share loser amongst all large automakers. So they're the one that had the largest, fastest market share loser. Despite its large size under Tavares, Stellantis became only a number 6 largest EV seller. This is a table that AJ creates, and you can see all the automakers selling electric vehicles. Tesla and BYD together make up all the rest. They're just tiny. So you can see that Volkswagen, BMW, Geely, which is a Chinese automaker, Stellantis is here. Despite there being the 3rd largest automaker, they're the 6th in EVs and basically barely above all the other companies out there. So they've made quite a small dent.
I mean, honestly, for where they're at, I don't think 6th is a terrible position with respect to EVs. Most of those are going to be hybrid vehicles of some form or another. So, I don't think that is the biggest factor in why they're in the difficult position that they are in. Quality issues in the United States, that's going to be a major factor in their ability to compete here. I have heard really good things about the some of the recent editions of the Ram pickup truck, but I think the other thing to factor in here is that we've had the union negotiations just over the last couple of years. And like I said, with the scale of Dodge compared to the Ford and GM organizations, I think it is probably difficult for them to come out in a survivable position in those union negotiations as well. And I think that is going to be another major factor. Um, yeah, they certainly could use some additional EV lineup that is decent quality. Um, I think that they've also fallen pretty dramatically in sales in China. And then obviously you can tell why that is. So it's just tough. And I think we're going to see, this is the beginning of these types of issues. We'll see more and more turmoil, and only the strongest of the legacies will probably survive the next decade, and it'll be a very chaotic path from here to there.
Mm-hmm. So what's I guess the good news for Tesla is you can see Tesla as a car company is doing very well. Okay. And everybody's going, but the competition is coming. Unfortunately, we've been reporting troubles with BYD, Volkswagen, BMW. We've reported problems with Geely, Stellantis, all of these guys, Mercedes, just literally, and Hyundai. I just keep going down the list. Every one of these guys, there was a big negative, issue that they're facing in the last
it's
just
a
couple
hard
of weeks
business
here. It's a hard business. But in the meantime, look, at least investors, institutional analysts are waking up. Tesla's not just a car company. They're an energy company. They've been talking about that now the last quarter. You can't ignore that. They're an FSD company now after October 10th. You can't ignore talking to Tesla about their progress with FSD and Robotaxi. They're a bot company. By the end of this year, they're going to see a third generation of the bot. They're going to actually have it physically working in the factories. Can you might push out that it won't be able to sell for another 2 years, but more and more, Tesla's going to be seen as an AI company. So that's a good news. Thank you so much, Hans. Appreciate you. Follow Hans on his X and YouTube channel, Hans C. Nelson. Thanks, everybody. Bye. I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.